Hello and good afternoon. Welcome to this Moneycontrol live stream to the closing bell with me, Yatin, Mota. When you talk about the Indian stock markets today, it has been a bloodbath, almost 2% each down for the Nifty as well as for the Sensex. If you look at the Sensex losing by over 1750 points, with the Nifty falling by over 550 points to close below that 25,250 mark. So from the all-time highs, we have lost a couple of big, heavyweights in terms of the contribution. If you look at Reliance Industries, HDFC Bank, Kotak Bank, a lot of large cap blue chip stocks bear the blunt of selling today. If you look at the mid cap end of the market, also almost 2.5% down on an average for the mid caps as well as for the small caps. So not going good there as well. If you look at the advance decline ratio also on the NSE, it was almost 1:54. So almost one advance for 5 declines. So the market breadth was extremely weak. If you look at the sectoral indices, all of them closed in the red. If you look at specific performance of the sectors, real estate, auto and energy were the most sold stocks seen in trade today. In fact, real estate and auto stocks were down anywhere between 3 to 4%. Lovisha, not a great day for the Indian markets. How do you see the large cap performance, and just take us through the highlights?
Yes, absolutely, Yatin. We have seen experts were also pointing out that the technicals have turned weak because of the overbought conditions in the market. But the nervousness also crept in after SEBI released some guidelines over the derivatives market. They proposed about 6 new changes in the guidelines, and that's what also kept investors on the edge. But yes, as you rightly pointed out, a broad-based sell-off that was imminent in the markets. We saw majority of the sectors drowning in the sea of red as well, be it the likes of FMCG, auto, all of them drowned in the sea of red. Nifty metal, that popped out in the screen as one of the outliers, but towards the end of the session, even that dipped in the red as well. India Wix, that was one of the notable counters that spiked up about 13% in intraday deals, now also settled about 9% higher to 13 levels as well. But yes, among the top gainers on the Nifty 50 list was JSW Steel after we saw brokerages upgrade the counter as well. ONGC, until and unless till the last minute also it was not popping up in the screen, but ONGC also did well in the last minute of the trade. Among the top losers on the Nifty 50, we can see BPCL, one of the OMC stocks not doing well on the Nifty 50 charts after Brent crude prices spiked up about 5% and is still holding about $75 per barrel due to the geopolitical tensions happening in the Middle East as well. Israel has also vowed a retaliatory response to Iran's 180 ballistic missiles as well. So we will be watching out on how those developments unfold in the upcoming sessions as well. Among the other top Nifty 50 losers were Shriram Finance, L&T, Axis Bank and Tata Motors as well. Do know Tata Motors has been giving quite a losing streak as well. They also posted a tepid September wholesale sales figures as well. But yes, Yatin, broader markets, that also saw quite a bit of a sell-off. What is on your radar this evening?
So if you look at the markets, stock specific action continues. Stocks like BSE, after the changes in the derivative segment and hopes of a market share gain from NSE, the stock gain almost 2.5%, was intraday higher by nearly 7%, but cooled off at the end of the day. Marico, after the strong quarterly update, moved almost a percent higher despite weak market conditions. If you look at stocks like HPCL, BPCL, the entire oil marketing pack that looked weak, almost 5 to 6% correction there. Obviously, there are concerns on the geopolitical side that what if Israel attacks Iran and the matter gets escalated. So I think there were some worries in the oil and gas sector per se, given the fact that the geopolitical situation is worsening, especially in the last 2 days. GMR Infra, Phoenix Limited, Oil India were the other stocks which saw profit taking, almost 5-6% down for each of them. But if you look at stocks like Polycab, Marico, BSE, those stocks hit fresh 52-week highs today despite weak market conditions. But yes, I think probably the China ETF money flow reversing its course from outflows to inflows, and for India, China's gain is something that India would lose in terms of the ETF flows. So some readjustments given the fact that China is running a stimulus and Israel has some geopolitical tension. So in the middle of all of that, I think we had a weak market today. and probably as you mentioning some high level profit taking and technically slightly on the weakest side.
Absolutely. But coming to some of the stocks in focus today, we saw, Dabur that has cracked about 8% in trade today after its dismal second quarterly performance. Dabur in its second quarter update, they pointed out that heavy rains and floods that has impacted its out-of-home consumption, and majority of the sales were being diverted to the quick commerce and the e-commerce channels away from their general trade inventory as well. Now, this lower primary sales that is expected to generate about mid to single digit drop in revenues in the second quarter. Post they registered a dismal Q2 business update. Brokerages like Citi and Macquarie, they came out with their calls and they cut the target price on Dabur. Citi's target price, came in line with today's day's low of Dabur's as well. While Macquarie, it sees about 10% downside from the current levels as well. While Citi has cut its FY25 to 27 estimates by 3 to 6%, Macquarie has cut the FY25 EPS estimates by a higher number, which is about 8%. Now, Yatin, today experts in the morning were also pointing out that, given the dismal Q2 business update, Dabur should be, most of the positives have already been priced in. And maybe the, investors should be positioning themselves on a hold for this counter as well. But what do you think at this particular point of time?
Lovisha, as you were mentioning, the quarterly update was weak, beat the monsoon factor or probably the quick commerce, platforms impacting the sales, because a lot of private labels are now available in terms of FMCG choices on these platforms. So, impacting growth, and I think the markets are really concerned. The valuations for all of these FMCG companies continue to remain high. There was hope that management commentary would be positive given the fact that we had a normal monsoon. But I think what spooked the street is not only the macro conditions and the market conditions, but also the concerns over growth, probably leading to almost 8% drop on an intraday basis for Dabur.
All right. Yes, that's coming in for Dabur. But one stock that was actually shining in this weak market was JSW Steel. At the end of the trade also, it was one of the top Nifty 50 gainers as well. And it was up about 3% in intraday deals as well. JSW Steel has popped up in the trade after two brokerages bumped up its target price on the counter, and they see about 15% upside potential. We are seeing a little bit of a bull run in the metal stocks as well. And Nomura has also shared a buy tag on the counter, and it has shared a target price of 1220 rupees per share. Morgan Stanley, on the other hand, they have also upgraded JSW Steel to an overweight and have shared a target price of 1150 rupees per share. Now, both the brokerages believe that the Indian steel companies, they are in a sweet spot, and the China stimulus measures is expected to yield positive sentiment as well. Yatin, looks like we are in a metals bull run, and experts are also picking up the stocks for their top buys in this expensive market. So do we expect this to perform well in this volatile market as well?
Well, Lovisha, it totally depends on the macro conditions. But yes, today Nomura as well as Citi, two big heavyweight brokerages coming out of the note on metal stocks, increasing and upgrading targets, augurs well for the sector. In fact, if you look at steel stocks, because of the import issues, they have a better spread. And more importantly, I think with the China stimulus coming in, a lot of development happening on the China front, especially with rate cuts and local government stimulus. I think metals will do well in the shorter term. But yes, the longer term performance totally depends on how sustainable is the China stimulus, because previous attempts have been not that great when it comes to revival of the Chinese economy. But this time, if the revival happens or probably stays for a quarter or two, I think steel stocks should do well, and that is what has happened today. Good moves for the metal as a pack in trade today. But moving from metals to pharma and healthcare, we have Jefferies, which has come out with a note on Syngene. They are underweight and recommend underperform call with a target of 640 per share. The reason why Citi has been slightly bearish or not that gung-ho about Syngene's growth prospects is the slowing biotech market. Now, if you look at Syngene's guidance, it was quite muted for the last 1 or 2 quarters. Probably the muted expectations as well as the bio spending in the US markets are slightly slower, which would mean that the growth again could be a challenge versus what the market was earlier expecting. In fact, Jeffries in its notes says that 60% of the revenue is coming from the research services and 15% of its revenue comes in from biotech firms. And given the fact that the ordering from biotech firms is not that great, we could see a slowdown in those segments. Most importantly, second half could be delayed in terms of the recovery which was expected earlier, and the trend suggests significant downside risk to Syngene earnings in the coming quarters. So, probably the reason why Jeffries is remaining underperformer when it comes to the rating on the share price of Syngene.
All right, that is pharma for you. And yes, defensives have been taken a forefront, and we'll see how that pans out in the upcoming sessions as well. But yes, Yatin, we were discussing about geopolitical tensions. We were discussing about, how Iran-Israel conflict has widened as well. And we'll see whether or not, the conflict pans out and whether it rattles the markets in the upcoming sessions as well. But today, OMC stocks, paint stocks, aviation stocks, all of them came under fire. BPCL, the likes of HPCL, IOC, Asian Paints, Berger Paints, and the likes of Indigo, SpiceJet, all of them came under fire, and they were all knocking down in the trade as well. Now, we'll see how this actually pans out. But, Yatin, just after, in the previous session, we saw that, airline stocks were doing well just after the ETF fuel price was cut. But now, today, we are seeing breather because of the, rising tensions in the Middle East. But, what do you think? I mean, do we expect this pressure to be continuing as well? Because the escalation could be a pain point for the OMC stocks and the other crude derivatives as well.
Exactly, and whether or not geopolitical things or tensions escalate or no, but the updates on the global front are trickling in. There is a lot of speculation in the market whether or not US is able to control the geopolitical tensions between Iran as well as Israel, or whether or not Israel will strike back Iran, given the fact that we had a ballistic missile attack which was done by Iran on Israel. A lot of questions, a lot of speculation, a lot of stories in the media. But we have the Chinese markets which are shut currently, so no signals from there. When it comes to the global stage, there is no clarity on how tensions would shape up in the next 3-4 days, because this period is quite crucial. Totally, the global scenario has changed. We also have the US elections in the near term. So I think the geopolitical news, the global politics will take center stage till the time we don't have a new US elected president in the month of December. So the shorter term probably could be volatile. And the guests which came on CNBC Awaaz were indicating that as a market, China trades at 10 PE, India trades at 23 times. So the attractiveness of Indian markets, especially in the large caps, has not that been great. Probably the time to re-adjust portfolio when it comes to the global fund managers. So how much of inflow outflow happens in the shorter term, we don't know. But as everyone mentions that in the longer term, India has a bright spot, and that view continues.
Yes, that's right. India is a bright spot, but we will see, how this pans out, because we have certain risks as well emerging up, and we'll see whether or not markets will be ignoring it, dismissing it, or will be afloating in the upcoming sessions as well. But on that note, we have come to an end of this edition of Closing Bell. We will be watching out for tonight's jobless reports that is coming in from the US. That will set a tone for US Federal Reserve's rate cut path as well. But until then, signing off, Yatin and me, for Closing Bell, but stay tuned to moneycontrol.com for more news updates and market insights.